house. It's one of the biggest financial decisions you'll ever make. And let's be honest, it can feel super overwhelming. You've probably asked yourself, how much do I need for a down payment? How much can I actually afford to borrow? And when is the right time to pull the trigger on buying a home? Well, I'm here to tell you you're not alone, and today we're going to be breaking it all down step by step. This isn't one of those fluffy save your coffee money talks. This is real guidance packed with practical advice and actionable steps you can start taking today. By the end of this video, you'll have a clear roadmap to not only buy your first home, but to do it in a way that sets you up for long-term financial success. Let's dive in. Step 1. How to save for a down payment. If you're watching this, chances are you've realized that buying a home requires money up front, specifically a down payment. But how much do you actually need, and how do you save for it? First, let's talk about how much you need for a down payment. The traditional rule is 20% of the home's purchase price. So for a $600,000 home, you'd need $120,000 down. But here's the good news. You don't always need 20% down. FHA loans might require as little as 3.5% down. VA loans, if you're a veteran, could mean 0 down, and conventional loans can go as low as 5%. The 20% rule is great because it avoids private mortgage insurance, also known as PMI, which adds an extra monthly cost. But if you're waiting to save, 20% means missing out on years of equity growth. It might not be the best move. Next, set a savings goal. Here's the first actionable step. Calculate how much you'll need based on your target home price and loan type. Let's say you're aiming for a $500,000 home with 5% down. That's $25,000. Break it down. $25,000 divided by 24 months is about $1,042 per month saved over 2 years. Knowing your target number makes saving less intimidating. It's now a monthly goal instead of an abstract mountain. Once you have your goal, create a dedicated savings account. Open a separate high-yield savings account specifically for your down payment. Automate a portion of every paycheck to go directly into this account. This keeps your savings out of sight and out of mind. Now, let's talk about reducing expenses and increasing income. I'm not going to tell you to stop drinking lattes. That's just not going to help you buying a house. But here are some real strategies. Cut unnecessary subscriptions. Negotiate bills like car insurance or cell phone plans. Pick up a side hustle if you can. Freelancing, consulting, even weekend gigs can add up quickly. Lastly, leverage assistance programs. In Orange County, there are first-time homebuyer programs and grants that might offer down payment assistance. Research what's available today or talk to a lender familiar with these programs. Step 2. How much should you borrow? So you started saving. Great, but how much house can you actually afford? This is where most people either overestimate or underestimate their budget. Let's fix that. A general rule of thumb is called the 28-36 rule. Your mortgage payment, including principal, interest, taxes, and insurance, shouldn't exceed 28% of your gross monthly income. Your total monthly debt, including car payments, student loans, and credit cards, shouldn't exceed 36% of your gross income. For example, if you earn $6,000 a month, your max mortgage payment should be around $1,680, and your total debts shouldn't exceed $2,160. This helps prevent you from becoming house poor, where all your money goes to your mortgage and you can't even enjoy life. Next, get pre-approved. Not just pre-qualified, there's a difference. Pre-qualification is a quick estimate based on your stated income and credit score. Pre-approval is a detailed analysis of your finances, credit history, and debt-to-income ratio. Pre-approval not only gives you a solid budget, but it also makes your offer stronger when you're ready to buy. You also need to plan for more than just one mortgage. Owning a home isn't just about a monthly mortgage payment. You'll need to budget for property taxes, homeowners insurance, HOA fees, if applicable, and ongoing maintenance costs. A good rule of thumb is to set aside 1 to 3% of your home's value every year for maintenance and unexpected repairs. And here's a big one. Don't max out your budget. Just because your bank says you can borrow $800,000 doesn't mean you should. Think about your lifestyle, saving goals, and future expenses like kids, travel, or retirement. A more comfortable payment will give you breathing room and reduced financial stress. Step 3. When is the right time to buy? Timing the real estate market perfectly is nearly impossible, but there are key factors to consider when deciding if now is the right time for you. First, focus on your personal readiness. Forget market trends for a second. Are you ready? Do you have a stable income? Do you have enough saved for a down payment and closing costs? Is your credit score in good shape? If you can answer yes to those, you're probably ready. Second, understand market trends, interest rates, inventory levels, and market demand all play a role. When rates are low, your borrowing power goes further. But don't let market timing paralyze you. Even if rates are higher, remember you can refinance later, but you cannot rewind time to build equity earlier. Next, think about your long-term versus short-term plans. If you're planning to stay in your home for 5 years or more, short-term market fluctuations won't matter as much. But if you might need to sell in 1 to 2 years, timing becomes more critical. Lastly, consider your emotional readiness. Buying a home isn't just financial, it's emotional. Are you ready for the responsibility of ownership? If you find yourself constantly checking listings, saving money diligently, and dreaming about your own space, it's probably time. Common mistakes to avoid when buying a house. Let's cover a few pitfalls I've seen people fall into. First, not getting pre-approved early enough. You find your dream home, but you lose because your financing wasn't ready. Second, focusing only on the monthly payment. Don't forget the other costs like taxes, insurance, and maintenance. Third, draining all your savings for your down payment. Always keep an emergency fund. And finally, letting emotions drive your decisions. Love the house, but make sure the numbers make sense. So here's your roadmap. Set a savings goal and start today. Understand your borrowing power with the lender you trust. Assess your readiness financially and emotionally. And when the time is right, take action. Do not overthink this. Owning a home isn't just about having a place to live. It's about building stability, security, and long-term wealth. If you're ready to take the first step, reach out to me. I'm here to guide you through the process, answer any questions, and make sure you avoid the common mistakes so many people make. And if this video brought you any value, don't forget to like, subscribe, and hit that notification bell. I'll see you in the next video.